Imagine putting $10,000 into an ETF promising to pay you every single week. Over 12 months, you collect $7,000 in pure income. The distributions land in your account like clockwork. But when you open your brokerage one morning, you find that despite all that cash, your account balance has collapsed to $4,200. The net result is a loss. You collected $7,000 in income, but you lost $5,800 in portfolio value. Even after all those checks, you are still down on the position. Many investors chasing the new wave of weekly options ETFs have lived through this exact scenario over the last 2 years. Massive cash payouts create an illusion of wealth, but they mean very little if the underlying asset erodes faster than the distributions accumulate. These ETFs generally follow the same blueprint. They hold a basket of highly volatile stocks, sell options against them to collect rich premiums, and distribute that cash to you every 7 days. When stocks drop, the fund can't cover payouts from gains. It drains your own principal instead. Section 19A disclosures confirm these high yields are occasionally 100% return of capital. You're simply being paid with your own money. Today, we're looking at 3 major competitors in this space: ULTY, ULTI, and KYLD. Each one attempts to solve the income problem differently, but their results prove that a cash distribution is not the same thing as a total return on your wealth. ULTY, the Yield Max Ultra Option Income Strategy ETF, was the pioneer. It launched with a strategy of writing covered calls on a concentrated group of 15 to 30 hyper-volatile stocks to generate the maximum possible yield. But look at the net asset value, or NAV. When those volatile stocks crashed, the fund's NAV cratered with them. No amount of option premium offsets a 60% decline in the portfolio. And by late 2025, the NAV had fallen 79% from inception. In December 2025, the fund added stable large-cap stocks to the mix and performed a 1-for-20 reverse stock split. This reset the optical price of the shares, but it didn't change the underlying loss for original investors. While ULTY advertised yields as high as 130% at various points, its actual total return since launch is only about 7.4%. For comparison, the S&P 500 returned roughly 50%. They expanded the portfolio to 100 holdings to spread out the risk and used complex, multi-leg option strategies, the kind typically used by hedge funds to manage volatility. For a while, it worked. This trendline shows ULT peaking with a year-to-date return of nearly 28%. Complexity doesn't guarantee safety, and low asset volume adds an existential risk to your money that has nothing to do with the stock market. Finally, we have KYLD. They took a deliberately different path, managing a global portfolio of 54 securities and prioritizing the stability of the share price over the size of the check. KYLD consciously capped its distribution yield at around 23%. That's the lowest in this group, but it was a calculated trade-off for better capital preservation. That trade-off paid off. Since launch, KYLD has outperformed ULTY by approximately 28% in total wealth created. Because it avoided the massive drawdowns, it was able to build more value for investors while paying out less income. This is the power of compounding. When your capital doesn't drop by 70%, your principal remains intact and can grow alongside your distributions. One thing to keep an eye on is KYLD's fee waiver. It expires in October 2026, which will likely cause the expense ratio to increase. Ultimately, KYLD demonstrates that sacrificing the dopamine hit of a massive weekly payout can be the key to actually building long-term wealth. These 3 funds aren't interchangeable. Which one belongs in your portfolio depends on your specific goals. If your goal is capital preservation, data points to KYLD. For traders wanting short-term income during volatility spikes, ULT works, with a strict exit strategy. But if you're just chasing 100% yields, you risk losing your investment to NAV erosion. Regardless of which you choose, you must monitor ULTY's return of capital notices and ULTI's monthly asset trends to protect yourself. Remember, a 23% yield that actually grows your principal outperforms a massive 100% yield that cannibalizes your underlying wealth every single time. True passive income requires you to look past the advertised distribution and demand a fund structure that actually preserves your wealth.